Manpreet Gill, Chief Investment Officer of the MENA region and Europe at Standard Chartered, joins in with his view on it. Morning, Manpreet. Thanks for joining us. Manpreet, it's a moment of pride for a lot of us sitting on the side where as India debuts on the JPM bond in Emerging Market Bond Index. First of many to come. I believe this would nudge the likes of Bloomberg and maybe even Barclays going ahead. But do you think this is well deserved, and what does this mean in sense of flows coming in? Because while this will encourage passive flows, active flows should have been coming in any which ways, because India is one of the best performing papers in the emerging market pack.
Good morning. Certainly an exciting time for all of us, both as Indians and of course as investors. But you're right. I think there's a difference between active and passive flows. Active flows can opportunistically come in. That's always been the case, right? And I think that's more about the regime that in terms of allowing foreign investors. But the passive flows are important because that's what allows a more significant amount of flows to come through on an ongoing basis. Obviously, that means that there's much more attention, there's much more capital inflows, potentially helps sort of impose more of a cap on bond yields than would otherwise be the case. So in terms of just bringing in a significant amount of capital flows, those passive flows are important. But as an opportunistic idea, absolutely. I mean, we've been excited about this since the end of last year, where we've highlighted as one of the potential trades, because during this inclusion process, usually ahead of it, is where you tend to see a lot of those flows take place. So we think we're already in the middle of what's an exciting period for a bond that looks absolutely, in our view, very interesting relative to emerging market peers.
What are clients saying? If I had to ask you this very directly, are all your clients investing in Indian paper at this stage? What is the feeling outside this country? Are you pitching Indian debt as opposed to maybe Indonesian paper at this stage?
Well, each of our clients in our business tends to be very different. But yes, when I think about it as a CIO house view, yes, it's been one of our top ideas for opportunistic portfolios since December last year. So that is one of the active ideas we've had on. And I think our rationale is more purely investment driven, right? Because one is, if you compare either from an absolute return perspective or relative to the rest of the emerging market local currency universe, that's really the benchmark here. The yield's interesting and the currency is stable. And what the flows do is create the possibility of some fall in yields or a modest amount of capital appreciation. So if you tick through those three metrics, absolutely, it stands out as a potentially very interesting idea. So from that perspective, we have been actively pitching it since December, obviously as part of our universe of opportunistic ideas. I think the yield and the currency stability, those very much remain in place. I think the key question is, now that we've got to the point of where index inclusion starts, whether that there's more to come in terms of potential capital flow tailwinds, or whether we've already experienced some of those. I think that's what we'll be focused on the second half of the year. But for now, it's an idea we very much have open and actively talking about.
So glad you bring that up, because I think the play really is the alpha generation through capital gains. Yields have already moved down in the last couple of months on anticipation of this inclusion. We've seen about $10.5 billion come into the market as well. From now onwards, would you be adding incrementally or recommending incrementally Indian paper, or would you be just sitting on your allocation and hoping that all this passive flow that's going to come in over the next 10 months will probably then take your yields down to 6.5, if that, by maybe FY25?
Well, the way I'd look at it is that if the basis of adding exposure was index inflows, then that period is most probably behind us. That's the reason why, in our view, at least, we've put on this idea in late December last year, till date. And that's what we've experienced in index inclusion, whether in bonds or equities, historically. That doesn't mean we necessarily close the idea today, but what it means is the basis of any investment view would change to just, analyzing it just like we'd analyze any other local currency market. So today, here on, it'll be much more about a view on bond yields and a much more about a view on the currency. And sitting here today, we just published a second half outlook. We've still sort of chosen to keep it on because we think, independent of index inclusion, the yield premium on offer relative to other emerging market peers, relative to other sort of income assets, and the fact that the rupee continues to be remarkably stable, those two factors still argue for it being an interesting trade. So the basis might have changed, but for the moment, we're quite happy to leave it on and continue to invest on the basis, even if it's just the carry.
Okay, Manpreet, just one quick question. Is there a question that comes in between India equity versus India debt now, that there is this event that has happened versus equity markets which have done so well but are expensive?
Well, I think that they're almost different asset classes, so I'd almost analyze them differently. And I'd say there's room for both. So we discussed the bond idea. Indian equity is something we've been excited about, obviously, for a long period of time. We've alternated between overweight and neutral over the last few years relative to Asia ex-Japan. But today, it's again one of our one key overweights. It's our only overweight relative to the Asia ex-Japan equity universe. Valuations, undoubtedly, I mean, that's the big debate. I think there's less debate about economic growth, policy continuity, earnings growth. Those factors are there. The reason we're still okay leaving it on is, yes, valuations are high, but we think they're justified by the ROE. And if you take sort of that sort of framework of the world, it's Indian equities, it's US equities where you see high ROEs, high valuations, but justified by high ROEs. So something we still have to monitor, but at least relative to other options out there, we still think it justifies an overweight.
Okay. Well, we are also joined, and Manpreet, if you have the time, please stay on, because we are also joined by the Director of Asia Pacific Sovereign Ratings of Fitch Ratings, Jeremy Zook. Jeremy, great having you. Thanks for joining in. What does, okay, great, and good to have you. What does an event of this magnitude, and I know this is now known since September, when JPMorgan first announced there is money that has come in as well. But today is the D-Day. What does an event of this magnitude mean for a nation like India, wherein all commentary suggests that foreign investors were craving, but they were wanting certain events to happen like this bond inclusion? What does this mean?
Yeah, well, thanks for having me, first of all. I think, this is certainly a big day for India, and we view bond index inclusion as positive for India's story. If we look at, what factors we're thinking about, certainly deepening of capital markets through bond index inclusion and greater foreign investor participation is a big benefit, we think. It helps to broaden the investor base. India at the moment is very reliant in terms of bond financing on the local market, and bringing in foreign investors to play a bigger role will help to broaden that investor base and lessen some of the risks around crowding out issues when it comes to government debt. We think it will help also in terms of financing India's modest external current account deficit at the moment. It does help bring in some greater external flows that helps on that external financing side. I think, over the medium term as well, generally we do see positive trends when it comes to bond index inclusion and government policies in terms of pursuing sort of a continued prudent fiscal and monetary policy framework. So we think, all of those factors are quite positive. I guess in terms of the credit rating, though, when we think about those positives, those are relatively medium-term issues, and so the near-term upside to the credit rating itself are somewhat limited from this bond index inclusion.
Jeremy, but would you agree, as compared to our emerging market peers, Indian paper, and this is numbers that we've seen, has been the best performing asset in the emerging market pack in the recent past. Our economy is relatively stronger than most others. Policy continuity is visible for everyone to see. Inflation seems to be contained, and we don't even seem to be too dependent on FPI flows, at least in the equity market arena. Do you now feel that India is in such a comfortable spot that none of the changes internationally could have a major impact on us?
Well, I think in terms of these bond inflows, I mean, certainly what will drive that is a lot of the passive inflows, at least from here on out. And those, we think will be beneficial. I mean, I think so far we have seen a decline in bond yields in recent months. That has been sort of a lot of the front running of this bond index inclusion from active investors. And so that has brought down yields. And so perhaps in the near term, some of the further declines in yields is perhaps a bit more limited, but still we could see some modest improvements in financing costs for the government. I mean, certainly in terms of the domestic situation, policy continuity following the election, despite the somewhat smaller margin for the coalition government, is, I think, a positive for foreign investors. Beyond that, of course, you have India's very strong growth story. And so those domestic factors should play a supporting role in attracting some of those active flows, especially. Of course, there is foreign investors do pay a lot of attention to global market volatility as well. So that certainly is a potential risk.
Right. Manpreet, all the money that we've been talking about that's been finding its way into the Indian bond markets already has about 10 odd billion. There could be 40 more coming. What is the nature of this money? Is this going to be sticky money? Because up until now, what we've seen is money that comes in as arbitrage or hedging money, right? Do you feel like this is the very first time that significant long-term money is going to be coming into India and could be the start of much more to come?
Well, yes, and I think the nature, it's a great question, right? Because the nature is different in two ways. I think one is exactly as you described, if it's index linked, it would tend to be stickier by nature because as opposed to taking, as a global manager, an off benchmark bet that's binary on or off, you're more likely to talk in terms of overweights and underweights. So scaling the flows, that's something which will happen as part of day-to-day market operations and views. But a negative view might be just less than usual as opposed to zeroing out, for example. So larger, stickier, longer-term capital. But the second is, I think, related to the previous conversation, the focus is likely to be slightly different because we're used to obviously the equity conversation, which is more about growth. But on the bond side, the focus is much more likely to be on the yield available, the inflation outlook, the fiscal balance and currency stability. So very different conversation, different type of investor. But all of these, to my mind, are good conversations to have. They're all signals of maturing and deepening of the market. So yes, different type of investor, different type of conversation. And I think that's really the way I'd be looking at it from this point forward.
Okay. Jeremy, Samina asked this to you, but I'm just kind of maybe wording it differently. I just wanted to understand from you. Indians globally remitting money year after year, and that is one stable flow. Now the bond market flows come in because we know that from whatever I read, that Bloomberg and some of the others will also include at some point of time the Indian bonds in their indices as well. So that end of the flow is stable, and if indeed growth stays stable, then it's a matter of time before FPI flows also trickle back despite the valuation. So that plus the RBI having the ammo even right now with the reserves that the Reserve Bank has, and the fact that the government has spoken about a glide path which they might overshoot in the budget as it comes, right? So do you reckon that there needs to be a relook for the ratings that a country like this has? Why or why not?
So we constantly monitor the ratings and the drivers of those ratings. So certainly we've seen some positive momentum when we look at some credit metrics in India, especially around GDP growth and external finances. Public finances, we still see as a bit of a constraint, even though, as you mentioned, we have seen some significant improvements there as well. So I'll turn to each of those, and certainly on the growth side, strong GDP growth will continue to boost India's economy, the size of the economy as a share of the global economy, continue to boost GDP per capita, which will be positive for the credit metrics over the medium term. External finances, over the past decade, we've seen quite a transition away from India being in the fragile five to now being in a very strong external finance position, modest current account deficits, relatively stable inflows, and the very large FX reserve buffers that the RBI holds. I think when we look at the public finance metrics, though, and we have to think about this relative to peers as well, because that is how we position our ratings to a large degree. If we look at India's fiscal deficit, while we have seen certainly a glide path down, and the government is showing very strong commitment to meeting its fiscal targets, deficits on a general government basis are still about 8% of GDP for this fiscal year. And that's compared to about 3% for peer medians. Debt is just over 80% of GDP compared to 55% for peer medians. And so a lot of those fiscal challenges still remain. Now, I think we are seeing progress on the fiscal front. We do expect that the government will achieve certainly the 5.1% that it set in February. And we think there may be a lower target set in the budget in July. And we do think that they will be able to achieve the 4.5% in FY26. So these are certainly positives, and that's something that we're watching quite closely in terms of how we see the general government debt trajectory over the medium term and whether that can be put on a more steady downward trend.
I mean, just one quick question, just moving away from India's inclusion on the JPM index and keeping the focus on budget, fiscal prudence, and of course the fact that what we've heard is BJP's coalition allies have been asking for financial packages for their respective states, and that was almost a given. Are you concerned? Are you worried that this could take a drain on our fiscal?
Well, I think we'll have to wait to see what comes out in the budget. I mean, our view is, especially this year with the larger than expected RBI dividend, that there is some scope for the government to use those funds to increase spending in certain areas while still maintaining the 5.1% deficit target, or perhaps even lower in the July budget. Certainly, I think what we've seen over the past couple of years is that these fiscal targets do appear a relatively high priority for the government, and we do anticipate that will be sustained over the next couple of years, and certainly that 4.5%, especially because it now looks very achievable. We think that will be an important metric for the government. I suppose where we could see a bit more in the way of a challenge is in terms of the composition of spending, whether the government can sustain that higher level of capex spending while increasing social spending or spending in other areas and continuing on this downward glide slope.
Right. Thank you, Jeremy. Thank you, Manpreet. We'd have loved to chat with both of you longer, but for now we're completely out of time. Have a good day, and I guess we'll hopefully catch up with both of you later.